There are only two kinds of investments. One, fixed income investments like bonds, which pay a contractual amount of interest over a specified time. And two, shares of businesses with rising income and dividends, or what we all call stocks. No matter what your age, stocks are the only answer. I am now going to make my case further for stocks as the only rational choice for people who don't want to outlive their money. Stocks dominate bonds, cash, and commodities. Even if you've never owned a share of stock or a business, there is still a good chance that you have personal experience with how wealth goes to the owner and not the loaner. Consider buying a home and taking a mortgage to do so. My father in law bought a house in Middletown, New Jersey in 1963. He paid $20,000 for it, which seemed like all the money in the world. His down payment was $4,000 and he borrowed $16,000 from the bank. 30 years later, he sold the home for $300,000 and retired to Sarasota, Florida. Yes, he did some improvements over the years. So let's say for an apples to apples comparison, the $20,000 house became $250,000 after the cost of improvements in a little over 30 years. What did the lender get? My father in law paid his mortgage, so the lender got its $20,000 back plus an interest rate. My father in law got all the price appreciation for the home. The bank got all of its loans back with a 6% or $1,200 per year income. As the owner, my father in law got all the appreciation, all the profits. If this seems logical to you, then you already know the difference between being an owner and a loaner. Even if you came to this video saying that you don't know the difference between a stock and a bond, we just demonstrated that you do. What are stocks? They are ownership shares of businesses. That's it. What are bonds? They are loans to businesses called corporate bonds, loans to governments called government bonds, or loans to banks called deposits or CDs. Let's see how these two interact. An owner might take out a loan to start or expand his business. The loaner gets a certain amount of security for his loan in the form of collateral, like the bank does when you get a loan against your house in a mortgage. But no matter how profitable the business may become, the loaner, meaning the bank or the corporate bond owner, doesn't participate in the profits. On the other hand, if the business is unprofitable for a long enough time and the owner can't repay the loaner will foreclose on the collateral. The inventory, the factory, the machines, or the intellectual property will be seized. The loaner to a business takes only the risk that the collateral may not be enough to repay the loan. If the loaner or the bank does its job correctly, it does not take much risk. Loaners take not much of a risk for not much of a return and zero chance of a home run if the business takes off. Of course, a business owner takes on much more risk than a loaner. If the owner can't repay the loaner, as we said, the loaner will seize the business's major assets, if not the whole business. If the owner succeeds, though, he gets to keep all the profits and all the increased value in the growing business above and beyond the face amount of the loan and interest paid to the loaner. It makes perfect sense, doesn't it? It's really that simple. Think about it for a minute. Almost everyone you know who has achieved lasting financial independence owned a business or was a manager or share owner in a business. In our free enterprise economy, that's how it's supposed to work. Look at the Forbes 400 wealthiest Americans. The top 15 all derive their fortunes from owning great businesses. You say that does not describe you. Yes, but tomorrow or any workday, you could purchase shares of great companies on the stock exchange, and you too will earn some proportional share of the wealth created there. Okay. We know that loaners take only the risk that their collateral will not be enough to pay off the loan, and that's not much risk at all. So loaners appropriately receive little return. Owners take on more risk, so their returns are higher, sometimes really, really high, but certainly higher than those of loaners. How much more do owners get? Let's look at the absolute returns of three assets: stocks, government bonds, and government bills for 1928, 2023. Now, this strikes me as reasonably dramatic. It shows that over a long period that saw depression, inflation, world wars, assassinations, stock market crashes, and economic booms, the owner of stocks got two times what the loaner got. But wait, these are nominal returns. What about inflation? These returns less inflation. And what about taxes too? I guess you can say that after inflation and taxes, the owner got paid five times the loaner, but it misses the real point that bonds have had almost no return after inflation and taxes. Stocks are the only financial asset that has any significant positive return. Real wealth went to the patient, disciplined long term owner. Am I promising stocks will continue earning 10% and bonds 5%? Nope, I have no idea what they will return over the next 30, 50 years. But it does not matter. All that matters is the vast gap between stocks over bonds, owners over loaners. To the extent that logic and a long history tell us the share owner will earn 2 times, 3 times, 5 times the bondholder's return, we know that stocks dominate bonds. But wait, stocks are too risky, you say. I say, whatever gave you that idea? What do you mean by risk anyway? Are the short term ups and downs in stock prices breathlessly reported minute by minute in the news media? Warren Buffett said in his 1993 shareholder letter that he defines risk using the dictionary terms as the possibility of loss or injury. Business owners define risk the same way, and as owners of shares of those businesses, we do too. Professors and big institutions who think they need precise mathematical measures of risk to protect themselves from lawsuits define risk much differently. For them, risk is the relative volatility of a stock or portfolio of stocks. Volatility is measurable, but uncertainty is not. And that's unsettling to lots of people. But the false precision in measuring past relative volatility obscures what real risk is, the possibility of losing money. That definition of risk is not some theory that requires high powered computers to calculate beta, beta, alpha, alpha, and standard deviation, sigma. It's a common sense way of measuring risk by avoiding losses. Like you, most advisors, brokers, and professional investors, for that matter, think the stock market is risky, meaning volatile. And as a consequence of this false belief, most people put too little of their money in stocks because they cannot bear the pain of watching the value of their savings go down in the short term. This is a problem, a big problem. Take a look at the stamps. The 3-cent stamp on the left was issued 65 years ago. The one on the right was issued in 2015 at 49 cents. That means the cost of stamps has increased by more than plus 4% per year for the 65 years of the retiree's life. Let's look at this increase in the postage stamp price as a proxy for inflation over the years. At 4% inflation for 30 years, consumer prices will rise more than 3x times during an average retirement. At 3% inflation, prices are still up 2.5 times. You will need about 2.5 to $3 of income to buy what $1 purchases right now. Or put another way, a dollar will be worth about 30 cents. If your father retired at 65 a generation ago, he died on average at 73. Let's say you're 65 years old now and assume your spouse is also 65. If you don't smoke, one of you will live until 95. That's what modern actuarial tables tell us is going to happen to the average couple. And if you're 55, 45, or 35 now, the plot thickens even further. The cost of living has never stopped going up in the 65 years of a typical retiree's life. The only reasonable assumption that we can make is that the cost of living will never stop going up. So if you need $100,000 a year of income in retirement to live the life you deserve, in the 10th year of retirement, you will need another $35,000. In the 20th year, you will need an extra $80,000 per year. You are not working. Where is the additional income going to come from? From your shares of great businesses. That's where I'll leave you with this. I was born in October 1964. The stock market, represented here by the S&P 500 index, was at $84 then. It closed last year at 2058 with dividends reinvested. That would be an 11,196% return or about 9.7% per year. So always remember this. Bear markets are only temporary interruptions of a permanent uptrend. Stocks dominate bonds, owners grow wealth, and loaners don quote T. Thanks for listening.